because this is the only place you will ever find where you can earn uninterrupted compounding interest while still having access to your money. Your money stays in the cash value, earning interest and dividends, while you get to use the insurance company's money. Every dollar you're repaying to the policy in a policy loan repayment is affecting the principal. So you're effectively reducing down your APR more. So as the math shows you, you're paying less by you being your own bank. Welcome everybody, another week, another wealth webinar. Super pumped to have you here. Also joined by Mr. Snaggy, and we've got Craig Yenny. And from what we hear, Craig is a freak in the sheets. We're going to get into that a little bit more. It's not the sheets you're thinking, it's the Excel sheets. Today, what we're going to do is we're going to crack the code on policy loans. We're going to crack the code on the interest paid on policy loans, and we're going to crack the code on the infinite banking concept. And today's episode is really all based on a case study, a real call that I got from a client, actually two clients to be exact, and they're both using the infinite banking concepts. They've both been using it for several years, 3 years, one has got to be 5, maybe even 6 years. He's been using this for, doing it all the right way, which, listen, folks, if you're kind of hearing this being like, I'm brand new, I don't know what the infinite banking concepts is, we're going to explain that, but they were using it. And at the end of the year, the insurance company sends out their policy loan statement. When they're looking at their policy loan statement, they see their cash value grew. They're like, all right, cool. I put in money and I made more than I put in. But then they got this little line that says loan interest due. And they were like, wait a second, I've been paying the policy loans, because they were recapturing the money back to the policy just as they were taught. Just as the infinite banking concept works, they were sending money out to work. One of them is a real estate, actually both are real estate investors for that matter, different types of real estate. They were taking the money from the real estate, rolling it back into the policy and doing a policy loan repayment. We call that recycle and recapture. And they were thinking, just like they would with any HELOC or any simple interest loan, that they were paying principal and interest, but they weren't. So when they got that policy loan statement, they looked at it and they said, loan interest due, I've been paying this, and they were confused. Well, today is all about debunking that, because how I just set that up, you're thinking, oh yeah, like why wasn't that paid? Why did they get a bill for the loan interest if they were repaying it? But before I get into that, let me ask, we've got about 140 people on here. Who is here for the very first time? Over in the chat here, put I, if you're brand new, if this is your first time on here. Let's check it out. We love giving shout outs to our new folks. Awesome. Look at this. Look at this. They're coming in. We got, go to the beginning. We got Lori. Thanks for joining. Rebecca. We got Jarrett. We got, how would you say that? Marisols? How would you say that, Craig? I hate getting people's names wrong. M-A-R-I-S. Well, welcome. I'm sorry if I said your name wrong. Sure. Craig, Stephen, you want to take a stab at that one?
Maricel.
Maricel? All right, got it. Connie, welcome. Felix, what's going on? We got a couple Felixes on here. We call the other one FCAT, so we will not get FCAT confused with you. We got John, Ace. I was talking to Ace a little bit ago. That's a pretty sweet name. Ace sounds like somebody that would fly a fighter jet. So if you're flying fighter jets, can I get a ride? That's all I'm asking for. We got Jay, we got Brian, Anthony. Mark Perry is not here for the first time, but glad to see you, Mark. Glad you're here for the first time. And let's see, we got a couple people here for the first time. We got Nestor here for the first time. Yvonne, what's going on? Got a couple of Yvonnes on here, and I think I got everybody. Fantastic. No jet yet, but jet coming, right? All right. So we always love giving shout outs to all of our new folks. And for all of you, I just want to do something really quick, because I just want to kind of set this up, because Craig, I know you're going to kind of want this. So what we teach folks is we teach people to change one thing. Okay. So that's essentially what we do, is we change one thing, and that is where your money, specifically your savings, goes first. Right now, your savings is probably sitting in someone else's bank. So we'll just call that the bank. And what we want to do, folks, is we want to teach all of you how to take back control of your money by teaching you how to be your own bank. And by being your own bank, what we're eliminating is we're eliminating the loss of interest that you're giving to everybody else. As defined, it basically is the process, the infinite banking concepts is the process of taking back the banking functions in your life. So what I want you to do is I want you to think, you go out and you work for this. This money right now goes into a bank account, some bank account somewhere. And what we're going to do is we're going to change where the money goes first. So it's not going to sit in their bank, because if it's in their bank, you're not in control of it. And if it's in their bank, what you're doing is you're actually allowing the bank to use your money to go out and make more money. And in most cases, this is sick, but this is what happens. The bank takes your money and literally lends it back to you in the form of a car loan, a credit card, a HELOC, a line of credit. And then you gladly pay them interest back. So how it normally would work is the bank gets your money, they send it out, they do something like debt, okay? They create some type of debt, and then you make payments back to the bank, and that payment that you make back includes interest and principal, right? This is just what we do, and the bank wins every time, but not if we change one thing and change that money to go to a place where you control your money, a place where you can earn interest on your money uninterrupted, meaning you can use the money at any time, but you don't stop earning interest on that money. That's pretty cool, right? So you put money in a bank account, you take that money out of the bank account, but yet the bank still pays you interest on the money, even though it's not in the bank anymore? Yeah, but it's not a bank that we're using, folks. What we're using is a specially designed and engineered, notice I said specially designed and engineered. A lot of people kind of miss that part, and they're like, oh, wait a second, I've never heard that. A specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends. Then what we're doing is we're basically borrowing the insurance company's money, and we're going to explain this in more depth. I'm just showing it to you real quick. We take the money out as a loan. The insurance company gives us a loan, essentially giving us part of our death benefit while we're living, and we use that money to go make more. Now, remember, I said this whole episode was two of my real estate clients. They were going out. One was developing real estate. One was lending on real estate. And then they were making money, and then they were recapturing and recycling the money back to the policy. This is exactly what all of you do today. You do exactly that. You put money into a bank account or somewhere else. You use that money to go invest it or do something with it. Sometimes it's even paying loans. And then wherever you invest it, you take the investment returns and you put it back into the bank. So this is nothing new. It's the identical thing you're already doing with one change. That change is you're no longer leaving the money sit at a bank. You're putting it with a giant mutually owned insurance company in a specially designed and engineered policy, whole life insurance policy, because then we get the ability to use the money without interrupting the flow and the earning potential of your money, compound interest. So with that being said, folks, we're going to solve the mystery that my two clients had. And we even have one of the text responses from my client that Shauna put in here. And I think this is kind of cool. I'm going to read this, Craig, and then I'm going to let you kind of take over. So this was my one client. He said, Chris, how do you book the business loans? I took a loan for my policy at 5.25% interest for a real estate deal through my business. My business makes monthly payments on the policy loan based on a 7.25% loan amortization. So how he figured that out, folks, is he just went online, and if he was going to take a loan from a bank, they would have charged him 7.25. So he literally just probably used something like bankrate.com, figured the loan amortization out, and used the exact interest rate a traditional bank would have charged. So he paid himself back the 7.25. So based on a 7.25 loan amortization, the carrier does not allow us to make more than the 5.25% interest on the loan. We make the spread in the form of forced savings, but we do not actually gain the spread or arbitrage in the policy. That's where he was wrong, and that's what we're going to unlock that. We're going to show you how you are actually getting that arbitrage. And he says, my bookkeeper is asking, how am I going to pay the higher payoff, meaning he's making the principal and he's making the loan repayment back to the policy, plus he's got this interest bill. Nonetheless, I said, I went over this the other day with somebody else, have several YouTube videos that explain this, but I'm going to give you a call on my drive home and explain this. That was my response. Literally, that's the text message from my client. So what we're going to do today is show you how he's doing everything right, which is putting money in the policy, taking loans from the policy. His loan interest rate was 5.25. So we have different companies. So it goes anywhere between 5, and the highest company we have right now is 6.7. But we're going to just use 5.25 because that was his. And then he invested in real estate, and then he recaptured the money at a rate of 7.25 because that's what a traditional bank would have paid him. Okay, so this is the infinite banking concept. So the cool part is if you can see, this particular client was already making a spread, doing it the right way. So he was making an arbitrary spread or an arbitrage, okay, of 7.25 minus the 5.25 the insurance company was charging him on the loan. So essentially that's a 2-point spread. But where he got hung up is when he was making this 7.25% interest over here. Remember, he amortized that when he did his calculation. Amortized means principal and interest. But by the insurance company's calculations, this 7.25%, whatever that was, when he was putting it back into the policy as a loan repayment, this was all principal. So at the end of the year, he still got the bill for the 5.25% simple interest that the insurance company charged him when he thought he was repaying the policy with principal and interest like his calculation showed. So he had a little conundrum. He thought for some reason he was not making the spread. He's like, wait a second, I'm not making the spread. This isn't what I signed up for. And I reassured him. I said, listen, you are indeed making this spread, plus you are indeed still earning interest and dividends. The policy he has pays 6.4%, and that is interest plus dividends. They call it the dividend crediting rate with the companies he's with. So he was making the spread plus, remember, he never stopped earning the interest and dividends. So that was uninterrupted compounding growth. So he didn't just make a spread, he made a spread plus whatever his policy earned him. I want you to all understand that before we get into this, that that's the reason why people use this concept. That's why real estate investors, entrepreneurs, professionals, the wealthiest people in America, right down to just normal folks that are trying to get out of debt, they use this is because this is the only place you will ever find where you can earn uninterrupted compounding interest while still having access to your money and other benefits like a death benefit, protection against judgments and liens, and tax-free growth. Because remember, this 6.4 grows tax-free if it's designed properly, which we design them properly. And we'll give you the opportunity to ask all the questions. So some housekeeping, folks. There's going to be probably 200, 250 people on this webinar. So any questions that you have, please put them in the question and answers, the Q&A. If you put them in the chat, we've got Stephen and Craig and myself who will be answering them. But sometimes when it gets crazy with all the messaging coming in, we miss one or two. So if you don't want us to miss your question or your comment, put it in the Q&A. And if you have to use the restroom, well, go. Because you don't, yeah, you get it, right? This is a webinar. With that being said, Craig, let's really kind of show them why this person was slightly wrong in how he was doing his calculations and why it actually worked out in his favor.
Yeah, let's talk about that some more. And one thing I want to point out on the board is if you can go back to that 5.25. So when he was paying that 7.25 back and it was all principal, did he actually pay 5.25% back on the loan interest?
Well, in the policy, well, no, he did not. But he thought he did because he just got a bill for the interest on the 5.25. But that isn't the case. So he did not pay 5.25%. And I know where you're going with this, so you're not going to get one over on me. But I think some of the folks over here are confused. They're like, wait. If the insurance company is charging you 5.25%, why did he not pay the insurance company 5.25%? And the answer is what, Craig?
Well, with the simple interest calculation, the buying down that principal, the interest charge will be less.
Right.
We'll show that.
Every month when he was making this 7.25% amortization loan payment back to his policy. And by the way, folks, here's one thing that is really important before, and then I'm going to just shut my mouth, but this is the most exciting part. So when he was putting the money back in the policy, recycling and recapturing this principal payment of 7.25%, he had full access to that money. So for example, if this principal payment was $500 a month, just making that up, when he put that $500 back into his policy, Two things happened. Number one, the $500 became immediately available to him because the insurance company applied it, and it just gave him more cash value to use because it repaid the loan, which repaid the death benefit he borrowed. Secondarily, he also, let's just say that this real estate deal was $50,000. I'm just making that up. When he made that $500 payment, as Craig was mentioning, he wasn't getting charged 5.25 on 50 anymore. He's getting charged 5.25 on 49,500, which if you charged 5.25% on 49,500, well, the interest you pay must mathematically be less than 5.25 on 50, right, Craig?
Yeah, that's what's happening. And there's something else. We're going to go all over all this again, but that interest, another really cool thing about how they're dealing with that is it's set to the side. So it's not added. Like if you have a HELOC, a lot of times that is just added to the, the balance. And so you'll get interest charge on that balance. So this interest in the insurance company is set to the side. And that's why they get that interest bill at the end of the year, although it's less, right? It's less than that 5.
So I think one of the things, and I see a couple chats, so we want to make sure we hit these if they're good questions because we want to make sure everybody's following this. Where a lot of people get confused is they're used to banks. They're used to traditional banks where a traditional bank would, if it gave you a loan, they would charge you interest every month, even if it was a simple interest loan, like a home equity line of credit. Every month, you got to make an interest payment to that bank, right? But the insurance company, when they give you a loan, they don't charge you interest every month. They charge you interest one time a year, which actually, I don't want to give the whole thing away, but let's just show them. It actually works out better in your favor because of the way that the interest calculations work. So go ahead from there, Craig.
So this might be a little repetitive, but I want to go over kind of the components of the policy. So Chris, on the board, you talked about the specially designed whole life policy. And what we want to do is talk about each of the pieces of that policy and how they perform with our loans and kind of what's going on as we take loans. So the first thing that we have are what we call premium deposits. So when you have a specially designed whole life policy, that'll be structured around the savings that you want to put into the policy. So let's say that's $1,000 a month. It could be $500 a month. It could be $10,000 a month. It just really depends on your specific situation. Now think of it this way. Every dollar that you put into those premium deposits is going to be used for your own banking system. There are some expenses, but the rest of that will just continue to compound uninterrupted for the rest of your life. So the money going into this bucket only goes one direction, and that goes up. And one of the special features of the whole life policy is that there are guarantees. So Chris, I don't remember the number you put on the board, but it was around 6.4. Some portion of that is guaranteed, correct?
So out of the 6.4% dividend crediting rate, 3% with this company is 100% guaranteed on that particular company. Every company is a little different, but this one was 3% of that 6.4 was guaranteed to never change for the rest of your life. And then the rest was the dividend.
Yeah. So just think of that guaranteed plus the non-guaranteed dividend, which have been paid out for well over 120 years, but those are the components that are making your premium deposits continue to grow and go up year over year. Actually, every month, every day, you'll see that going up. The next bucket that we want to talk about is the cash value, and I put in there ledger, but it's really just an indicator of how much cash you have available to request from the insurance company. So I think of the cash value ledger as kind of like a gas gauge. So I don't know if you can see on the bucket, but there's a gas gauge, got empty over here on the left and full on the right. And this cash value ledger is going to behave similarly to how your gas gauge works. If you go to the gas station, you fill up your tank, you're going to be on full. When you put your premium deposits in and you don't drive anywhere or you don't use any loans, you're on full. What happens is, let's say you've got 50,000 of cash value available as a loan and you take out 10. Well, your available is now going to be 40. Let's say in 2 months later, you pay that back. It's back up to 50. So think of this cash value ledger as just kind of going up and down depending on how you're using it. It doesn't change the fact that all of your compounding is happening uninterrupted. This is just simply a measure of what's available to take as a loan. So it's going to go up, it's going to go down. You take some out as a loan, it's going to go down. You put some back in as a loan repayment, it's going to go up. Now, the thing to realize is Chris, when you did the drawing and you said there's $500 going back into the loan repayment, that's going back into that cash value ledger, which then becomes available again. So it doesn't include the interest at this point.
Correct.
Yep. So these two buckets are really important to understand. And one of the things to remember is this cash value is an advance of the death benefit. So when you have a death benefit, the insurance company is saying, we're going to allow you to use some of this death benefit now as a living benefit. And so we don't have to wait until we die to get the benefits of a whole life policy, especially designed whole life policy. So this is just going to be one of those numbers that helps you understand what's available to take as a loan to go put into real estate. Or I was kind of kidding around with Ace earlier. If you want to go buy your plane and this is how you're going to buy your plane, or maybe you're going to buy a car, put your kids through college, pay off debt. These are all the things you can do with your cash value. The third bucket, let's talk about, is the death benefit. When you have a specially designed whole life policy, there will be a death benefit associated with that. And let's just say the death benefit is $200,000. That doesn't mean you have access to take $200,000 of loans, but that means that some subset of that death benefit, it could be $25,000, could be $10,000, just depends on the design initially, is going to be what you're available to take as a loan. But here's what happens. If you have a $100,000 death benefit and you have a $50,000 loan and you pass away, or you graduate as we call it, that means the insurance company is going to take that $50,000, that loan balance, off the death benefit and pay the rest out to your family. And this is really important to remember because the insurance company is making a very safe loan because they know that at some point that death benefit's going to be paid. Someday you're going to graduate. And so they'll just say, whatever loan you have outstanding, we'll take it off the death benefit and pay the rest out to your family. Okay. Now the last bucket is big. And the reason it's big is because this is the life insurance general fund. So all of the mutual policy holders, when they make their premiums, they've got this big bucket called the general fund. That's what the insurance company will take out and invest. They'll put it in bonds, they'll put it in real estate, they'll do policy loans. So when you're getting a policy loan, guess which bucket it's coming from. But for everybody that said the policy comes from the yellow bucket or the big one, I saw someone said, that was kind of funny, Christian. When you get a policy loan, the proceeds are coming from the big yellow bucket, the general fund of the life insurance company. So now that loan that they're allowing you to use is money that they can't go put into other investments, but they're okay with that because they've got the death benefit, they've got your cash value as that collateral. So these are the components that we're dealing with. So just remember, you put your money in the premium deposits, that's just going to continue to grow and compound. Your cash value ledger in your policy is going to go up and down depending on your use. As you put more premiums in, cash value is going up. As you pay loans back, cash value is going up. As you take loans, cash value is decreasing. So that's just a kind of an up and down bucket. Death benefit, that will always be deducted. The loan amount will be deducted from your death benefit at the time of your death if you have a loan. Rest goes to your beneficiary. And then the last bucket is just our general fund. When we pay interest, it goes into that bucket. When we take a loan, it comes from that bucket. All right, so I've got some other fun buckets. Who likes buckets? I just try to figure out, if the buckets are working, let me know. But if you have any questions, put them in the chat. We can answer them. All right, buckets work. Here's what we're going to do is we're going to kind of walk through some of the motions of how the money flows. And so let's say Chris wants to take a $10,000 policy loan, or maybe you want to take a $10,000 policy loan. We already know that it comes from the life insurance company's general fund. So what's going to happen is I'm going to say, I would like a $10,000 policy loan because you have that much available. The life insurance company is then going to deposit that into your bank account. One of the common questions I get is, hey, since this is kind of my own banking system, do I get my own debit card? Do I get my own checks? The answer is no, you don't get your own debit card, you don't get your checks because the life insurance company is not a transactional banking kind of system, but they will allow you to request a loan and then they'll deposit that in your bank account. We oftentimes encourage people to set up a separate bank account from their grocery bills, from their operational monthly expenses. We call that a segregated account. And so this is just going to be that one account where loans get deposited into when you pay your premiums that may come out of that. It's just a bank account. Could be at your credit union, could it be at your national bank? It doesn't matter. It's just a separate account specifically for the use of the infinite banking process. All right. So step one is really just about how the life insurance company loan is getting to your bank account. Now from here, we're not going to go into a lot of details on how to use infinite banking today, but let's say that you have debts. If you have debts and you want to be able to pay those off more efficiently, can you use this process? Absolutely. If you want to finance a car, can you use this process? Absolutely. And Chris shared, we've got some clients that are doing real estate. A lot of us do private lending with that. That will work as well. So once that money's in your bank account, the life insurance company doesn't care what you do with it. They're not going to ask you what you're going to do with it, but you're going to go build wealth, pay down debts, use it for financing major purchases. All right. So what happens during the policy year? So when Chris was sharing about the client who is paying that 7.25% back to their loan, what's happening is out of your bank account, you're making payments, and let's say it's $500 a month, it could be $600 a month. It doesn't matter. It's whatever you want to put into it. This is really an important distinction to remember is every dollar that comes out of your bank account when you're paying down those loans during the year, all of that is going in to reduce your principal. And I'm going to make sure that everyone's listening. So I have a question. We're going to put it, and if you know the answer, put it in the chat. When dollars go into that principal bucket, and I'm paying that down, what happens to my available cash value? Who can tell me what happens to my available cash value? Yes, look at all those people. We've got some rock stars out there. They're listening. All right. That's exactly right. It's going back up. So if I put $500 into my principal bucket to reduce the principal, yes, my available cash value goes up 500. All right. Now what's happening to my interest bucket? It's just going to keep accumulating, but it's going to be accumulating based on my available or my remaining balance of principal. And yes, Sean, at a lesser rate, because as my principal gets reduced, just like Chris showed on the board, that 5.25% on 50,000 is different than 5.25% on a 49,500 loan. So as we continue putting more money back into that principal bucket, our interest costs keep going down. So that's the cool thing about it. All right. So I think we've all got a really good handle of this. You guys are doing great. Everyone's jumping on the answers. Okay, so here's what we're going to assume. We're now at our policy anniversary. And for everybody that wants to know more about that, just think of your policy when you start it. Let's say you start it March 1st. Well, then every March 1st, that's your policy's birthday. That's when you have your policy anniversary. And that's when the insurance company is going to say, they're going to look into that interest bucket and they're going to say, you have X amount of interest that needs to be paid. What would you like to do with it? I'm going to show you two options. Option one is you tell the insurance company, I don't want to pay my interest this year. Well, what they're going to do is take that interest bucket and dump it into your principal bucket. So now whatever interest you had accumulated, it's just going to be put on your principal balance, and then you're going to go into the next year and just keep going. And we can show you the math of why that is okay. It's actually more efficient to just dump that interest back in the principal and keep going. Now, if you have the interest money and you want to pay it, you certainly can, and this is what it looks like. So out of your bank account, you would still be paying principal, but at your policy anniversary, you can say, well, I want to make an extra payment and just wipe out the interest in my interest bucket. So now we're not going to add that to principal, but we're just going to pay it. So that's just some money that comes out of the pocket. All right. So you have those two options. You want to pay it? Great. If you don't want to pay it, the bucket gets dumped into the principal bucket. And that's really all there is to it. It's just those two decisions. They're not going to say, guess what? You didn't pay your interest, so now we're going to, charge you a fee. They don't really care. So it's really up to you as being the banker. And I'm going to show you some math in a little bit on why it makes sense to be an honest banker. But anyway, those are the two things I want to cover just about how the loan interest gets paid. Chris, anything we need to address live question wise?
I'm just frantically answering them over here. And just so everybody remembers, I'm not looking at the chat right now. We got a bunch of them over in the Q&A. So if you got a question in the chat and you're like, I wonder why he's not answering, it looks like he's typing, put it over in the Q&A and I'll get to it. Outside of that, you're just getting to the really good part, because I know there's been a bunch of questions that are all about like, how does the mechanics work of what you just explained? The interest, the two options, interest getting paid, separately, or interest being paid, the way you just explained, or not pay, I'm sorry, not paid at all.
Yeah, and I see in the chat, Lucy had asked, so they don't force you to pay interest. When I got my first year interest notice, I didn't think I had a choice. So yes, they will send that out as like, here's your interest. And if you don't pay it, Lucy, what they'll do is they'll just add it to your principal. So it's not required to be paid, but it may look like it is, but it's not required. So this is just a calculator that shows the policy behavior that we just went over, but I want to show you the math of it now, just to kind of reinforce what's going on. So let's assume we're going to take a $10,000 policy loan. So we put the $10,000 in our $10,000 in our calculator. I'm assuming it's a 5% interest rate. So up here I've got 5%. Now, here's what's going to happen is if I don't pay any principal throughout the year, so you see where my loan payments is 0, 0, 0, 0 through the whole year. Okay, so the 10,000 is going to be my loan balance at the end of month one. They're going to take a portion of that interest charge, which is 0.417, which is just a 1/12 of 5%. And they're going to say, all right, you've accrued $42 of interest. So now if I want to pay this loan off in full, I need to make a $10,042 payment. However, what's going to happen is that $42 kind of gets set to the side. Month two comes around, we still have a $10,000 loan balance. So now we're going to, have another interest charge. And so now our total interest is 83. And you'll see throughout the year that keeps going up. And guess what? No big surprise. If we have 5% interest rate on a $10,000 loan, we're going to accumulate $500 of interest. So there's nothing magical about the math here just yet. So hopefully everyone's with me so far. We're just simply accruing interest because we didn't knock down our principal balance. Now, what happens if I get that bill at the end of my policy year and they say, hey, Craig, you've got a $500 interest charge. Well, I don't want to pay it. What happens is when we get into the next year, so in the first month of year two, my principal balance is now $10,500, and we'll just keep on going. That's perfectly fine. Or I could say, you know what, I've got the $500 cash sitting here. I'm just going to pay it off. So that means I paid my interest balance, and going into year two, my balance is $10,000. So those are just the same things we talked about with the buckets. Do we pour the interest bucket into the principal, or do we just pay it? So those are the two things that you could do at that point. And I mean, if you want to pay a portion of it, you could say, well, I only want to pay $300. Well, that means the $200 is going to get added to your principal. So guess who's in control of everything at this point? Guess who's in control of how and when that gets paid back? Is it the insurance company? It's you. Yep, you're exactly right. All right, so let's go ahead and say we are going to be paying back our system $500 every month. So for the first 12 months, we're going to put $500 a month back into the loan. What happened at month one? Well, we reduced our principal balance by $500. Instead of paying $41, we paid $40 of interest. Next month, our principal balance is $9,000. Now we're paying $87 instead of an accumulated $83.
Hey, Craig.
But yeah,
real quick, somebody's challenging your skills in the sheets here.
Okay.
Samson saying the total insurance in column J should be $343. It did not update when you made a $200 payment.
All right, let me just go back here, look at something.
Just want to make sure we got the right math.
If I make 300, So this is because this is taking the $500 accrued interest and I paid 300 of it, 200 gets put onto the next year. And so then I have $43 of interest going into the 13th month. This 500 is already accrued. I have to pay it.
That makes sense, Samson? I just want to make sure that he kind
Yeah.
of knows how it's being calculated. But
Yeah.
yeah,
So,
he'll probably respond back.
okay, perfect.
Yeah, he said
Yeah.
all
So,
good.
so that it's just maybe it wasn't clear, but these numbers are kind of the end of that month. And then so if I put 300 in, it's just going to reduce that overflow going into the following month. So, but yeah, that's a good observation, but that's what's going on. And then let's put our 500 back in. Yeah, thanks for stopping me on that. So then what we're going to do is just continue on down the road. You'll see the loan balance keeps going down by $500 every month. Now over here where we see the total payments, here's another question. If you know the answer, put it in chat. But let's say I get to month 10, and how much has my cash value gone up in terms of my loan repayments? So of all my loan repayments, how much has my cash value increased or the available amount increased? Yep. Sam's got it. 5,000, 5K. Yep.
He's on it,
Exactly.
man.
So
He's on it.
yep. So this 5K is not, it's kind of, if you think about when you pay a car loan or you pay the bank back on a loan, well, that 5,000 that you paid, that's their money. This 5,000 becomes something you can use again. And so that's a big difference that we all need to remember is you might feel that this is a bill that you're paying, but that 500 is just you're taking it from one pocket and putting it in another pocket. This is still available to you to use again. Yeah, like a line of credit, exactly.
Yeah, we just had two questions. Can you stop sharing? I want to show something on the board that I think, for
Okay.
me, I struggled with this in the beginning, so I would have to imagine some folks are struggling. So there's really three interest rates that we're talking about when we're referring to that. So let's just break down these three interest rates because I just had a Q&A question. First off, interest rate number one is the guaranteed contractual interest, okay, that you're getting on the policy, which in this case, 6.4 is your dividend crediting rate. Of the 6.4, 3% with this insurance company is that. So that's interest rate number one. Everybody understands that. That interest rate is building upon your cash value, which is just like a balance in a bank account that you can use, right? So your cash value is the money you have to use and the money that is compounding with interest and dividends. You're paid interest, and that interest is compounding on a daily basis. Okay, so if it's 3%, that's your annual 3% rate, but every day they're calculating that interest into your cash value. Okay, the dividend is paid one time a year. So that's interest rate number one. Interest rate number two is the interest rate that the insurance company charges you when you take a loan from the policy. Because remember, when you're taking a loan from the policy, you're not actually taking your cash value. Your cash value stays in the policy. The insurance company, like Craig showed, from their general ledger is lending you money, and they're basically subtracting it from your death benefit. So they do charge you interest. This interest here, the 525, that is not going to increase your cash value. That is money that one time a year you will pay to the insurance company. That is what we call a cost. So number two is the cost of the capital. Okay, so that's what you got to pay. Interest rate number three would be over on this side. In this example we were using is this is a real estate investor. So let's pretend that they lend the money on a piece of real estate at 12%. That 12% interest you're earning. So that 12% interest, what we're doing is we're sending that back to the policy to repay the principal, repay the loan balance down and then replenish that money. So whatever this 12% interest rate is, that money just goes right back into your account. And think of it this way, don't get confused, because this is interest rate number three. This is exactly what you would normally do. If you lent me money and I paid you interest, you would take the interest check that I gave you and you'd go deposit it into your bank, would you not? So think of it just like that. This right here, this loan repayment is no different than you just going to the bank and depositing it into the bank, except for you're putting it back in the policy, because that's where it's going to make you more money, because you're going to reduce the loan balance, which means the insurance company, the way they calculate the interest, is going to charge you less interest, called the APR, on the money. So interest rate number one, you're earning. Interest rate number two, you're paying. It's your cost of capital. Interest rate number three is money you're earning because your money is working for you. hopefully that clears up that question.
We were kind of going through, just like Chris was saying, in that case, 12% in that real estate deal, taking the full amount and running it right back into the policy. And so if we continue taking, say in our case, the $500 and running it back to the policy, our interest charge at the end of the year is now $338. It was $500 when we paid nothing, so that's the 5% of the 10,000. But because we reduced the balance, we are now paying 3.38% APR on that money. Now 3.375 actually. So you'll see as you continue on down the road, that APR, as time goes on and you keep adding more money, it becomes cheaper and cheaper money, because guess where that 338 is going? If you pay that, that's going back into the insurance company. That's their money. However, you're a mutual policy owner, so in an indirect way, that's still something you benefit from in the dividends. However, 6,000 that you paid increased your cash value. You had a cost of 338 that year, and maybe you had that $10,000 working out at 12%. So you made money compounding the policy, you made money in your real estate deal, and you had a little tiny cost of insurance, of interest from the insurance company. So that's kind of how some of the math is working inside of the policy, and how you pay the loans back, and kind of how the math works out. So any questions on that? Because it's pretty cool. And once you understand that, you'll understand that I'm not making a bill payment back to the loan. It's actually, most of it's going back into your ledger to make it available again. So we already kind of covered this. This is where the interest gets added to the policy anniversary. This we covered already. Now, there was already some observations that this is like a line of credit, and that is correct. I mean, a lot of us in this community use first lien HELOCs, or we have second lien HELOCs. But I wanted to draw out just the comparison of a HELOC is still simple interest. There's a lot of benefit to using a HELOC, and I love using my HELOC. But there's a little extra advantage to using a policy loan compared to a HELOC, and I just wanted to show that math. So this is a HELOC loan at $10,000, balance, and let's say we pay $500 a month at 5%. I'm not going to go through all the numbers, but I'm just going to draw your attention down to month 20. So by month 20, if you've made $500 payments back to a HELOC, you accrued about 407, actually it's 446, I think, of interest, but your annual percentage rate is 2.44 on that. Actually, I may have screwed up. Let me just look at something real quick. Yeah, so I actually have the wrong picture in here, so pardon me, but this is kind of the net of it. So you have to think about in a HELOC, what's happening. Well, they're charging interest, and that interest is getting put back into the balance. Whereas on a policy loan, that interest is not getting put back into the balance. And although there's simple interest, there's a little bit of difference. So in a 3-year loan, $10,000 at 5%, your policy loan, you would have paid $407 of interest. On a HELOC, you would have paid $463. So we're looking at an annual percentage rate of 2.4 versus a 2.78. And so they behave very similar. I'm just simply drawing out the fact that the policy loan, because of the way the insurance company calculates that interest and kind of sets it to the side, you do have a higher benefit to using the policy loan, all things compared.
This was like the sum up for me, Craig. This slide was the one that I really wanted to drive home for everybody here, because, a lot of time, and first thing I want to explain here, and, because I just had the anonymous question who was not understanding this, because we get some people that say to us, so how much does it cost to use my own money? You're not using your own money, first off. I thought we drove that home, but, some people just got to hear it a couple times. So you're not using your money. Your money stays in the cash value, earning interest and dividends, while you get to use the insurance company's money. So it's no different than when you have a home equity line of credit, as shown here. Whose money are you using? The bank's money, right? But really, what money are you, what are you leveraging? You're leveraging the equity in your house, the money in your house that normally you can't use at all, right? I've never seen somebody go outside their house and listen, if any of you know of a house that does this, please give me the address. But go out of their house and turn on some faucet somewhere and it starts spitting money out, which is the equity of the house. Anyone ever seen a house that does that? Because I have not. Hence why we have home equity lines of credit. So we get a home equity line of credit so that we can use the equity in our house. Now, while we're using the equity in our house, now remember this is key. When we're using a home equity line of credit, so let's say we got 100 grand in equity in our HELOC. We take that 100 grand out and we use it to buy, let's say we use it to lend in Private Money Club. Does that house still continue to appreciate and in value? Yes, it does. And did it matter that you took the money out using the HELOC? No, that did not interrupt your house's appreciation. Now, as long as you understand that, which I know every one of you, including Anonymous, understand that. The policy works the exact same way. You're putting money into the policy in form of premium deposits. That is building your cash value because these are specially designed and engineered whole lives. So every dollar you're putting in, the majority of all your dollars minus the cost of insurance, the policy service fee per year, which is $50. The most is $100 for one of the companies we have. So outside of those two things, your policy's cash value is building. And then when you want to use that cash value anytime, immediately in the first 30 days, if you want, you can take money from your policy, but you're not taking your money. Just like you didn't take your money from the HELOC, the bank gave you the money. In this case, the insurance company is giving you the money from their general account. But the money the insurance company is giving you is very different than the money that the bank is giving you, because the money the insurance company is giving you, pay attention, Anonymous, is actually the insurance company advancing you part of a death benefit that they will have to pay when you die. So because they're giving you a death benefit that you would normally get only when you die, the insurance company isn't asking you for the principal back. Now, we're still paying the principal back to them because economically we make more doing it that way, but they'll never ask you for it. Ask anybody on here who has a policy. Has the insurance company ever sent them a demand letter to repay their loan? No. The insurance company sends them a bill at the end of the year asking them to pay the interest on the money that they took, just like every one of you, Anonymous, you included, pay on your home equity line of credit. It's the same freaking thing, except for economically, as Craig just showed, you pay less. And I don't know anyone that I've ever met that wants to pay more. They all want to pay less. So as the math shows you, you're paying less by you being your own bank. And it's basically the same thing. You just don't have to own a house.
Yeah. So it's almost like when you take a loan on your HELOC, if you sell your house, they're going to deduct that from the equity. You have a policy loan, you more or less have equity on your life, your death benefit. If you have a loan, they're just going to remove it from your death benefit. So they're very, very similar vehicles. It's just that we're showing that there's a little bit of benefit to the policy loan and how they do the calculations. But if you understand HELOCs, you'll understand policy loans with this one extra step of how that interest actually works on the policy side. So
and I want to show one other thing before we move on. If I can, I'm going to go back to that client. Okay, so we're going to get rid of some of this. And actually, I'm going to leave this because Shauna said you should circle the interest you're earning in green. So interest number 1 you're earning, interest number 3 you're earning, interest number 2 you're paying. What I told that client, because they're running a business, they're doing loans for business, and they want to make sure that they never get a surprise invoice. So what I suggested that they do is every time we do this, actually, let me do another example here. This will make this really easy. Normally, when we draw this, we show you over on this side, you got the whole life, which you're changing one thing, and that's where your money goes. You're then taking loans from your policy, okay, which is using the money. We use 525. And then that loan is going into, we have every one of our clients set up a segregated bank account. All this is a second bank account at your local bank that you like to go to. The reason for this is books and records. This allows you to keep books and records of every transaction that happens with your banking system. Then you take the money from your segregated account, either ACH, wire, or check, and then you put it into whatever it is you are. My client's example was they were using it for real estate. Then they were taking, and what my client did is they figured out, okay, the bank, if I were to have bought this property using someone else's bank, they would have charged me 7.25%. So what he did is he ran a calculator bankrate.com, to figure out what would the monthly payment be on this house if he were to borrow from a traditional bank. I don't know, let's just use $500. Principal and interest, okay? This is P and I. And this is just how he did it. This is not how you have to do it. You're the bank, you make the rules. So then that $500, what he did is he set up an ACH every single month. He would get the money, okay? And he would put that money into the segregated account. So now $500 came into his segregated account every month, which is, he's not putting any, so I want you all to understand something. What I've shown you up to this point is nothing different than you're doing today. Every one of you, in order to do this, you have to be saving money. My client was saving money as you are. We're just going to change where the savings goes. We're going to put it in this specially designed whole life policy. And every one of you are going to invest money in one thing or another, S&P 500, real estate, private loans, whatever you want to buy. So that's what he did. And then he just took that money and put it back into this segregated account. Again, nothing here is any different than what he was doing before. He's saving the same amount of money. He was spending the same amount of money he would have, because he would have taken a loan from a bank. Matter of fact, it's arguable that he spent less money because he didn't have any closing costs. He didn't have to pay the bank attorney. He didn't have to pay the points and the fees to the bank. He's the bank. He could charge himself anything he wants. But he said, I'm going to pay myself the same amount, $500. So here's what I said to him. I said, okay, because every year the insurance company, one time a year on your policy anniversary, the insurance company is going to send you a bill for this loan interest. Well, it's really easy for us to calculate that loan interest. Can you pull up the loan calculator real quick, Craig?
Yeah, sure.
And I want all of you to know that we value every one of your time. So we are willing to give all of you this calculator if you want to use this. It is a simple calculator to use. It allows you to factor and calculate anything you want from loan interest. But he basically, we would figure this out for him. So we gave this client this calculator so that he would know how much interest was owed at the end of the year. So just like this, let's say the loan was 10 grand for the house. Obviously it would be more. He was making $500 payments, as I'm illustrating. And now what that's going to say is at the end of the year, he's going to owe $338. Okay, so follow with me, folks. Okay, Craig, let me have the screen back. He knows that $338 a month, or sorry, $338 for the year, my mistake, is going to be owed in interest. So what I said is out of the first monthly payment, I think I'm doing this correct, right? In that example, keep $338 in the segregated account. Send, let's see, what's the math on that? 220. Oh shit, no, that's 6,000. Can you, what's 6,000 minus 338?
That would be $5,662.
$5,662?
Yes.
So over the course of a year, what he's going to do is he's going to put $5,662 back in his policy, which is not $500 a month, because he's holding back $338, which is what we're going to call the sinking fund. This $338 that we're having him hold back is going to be enough to pay the interest to the insurance company. So why did we do that? Well, so now all he does is when he gets that bill at the end of the year, from his segregated account, he writes a check or does an ACH to the insurance company, boom, done. Business as usual. No extra money came out of his budget. No extra money came out of his pocket. It was all calculated. He used that calculator, and all he did is he just held that money in the account. He just knew at the end of the year, I'm going to owe 338. He's not going to owe 500, which most people, when they would think about it, they're like, I'm going to owe 500 because they would take the 10,000 times the 5%. They're like, okay, I owe 500. But no, you've been paying the loan interest or the loan balance down. So he only owes 338, not 500. You see the economic benefit to him for doing this? So then that 338 is just a sinking fund and all is the same. I know that was fast. Maybe not everybody caught that, but that's what we told him to do. He had a light bulb moment. It was like, ding, and some of you are having that light bulb moment. He's like, I get it. This is exactly what I needed to hear. Like for us, sometimes we don't realize it. To us, that's just common knowledge. That's just like, well, yeah, logically, duh, that's what you would do. But for some people, they just need to see the light. And he saw the light and he's like, that's perfect. No extra money out of the pocket, no cash flow issues at the end of the year, same dollars, nothing changes. He just holds a little bit back. That's it. Was that helpful?
Yeah. I know there were some questions on that 338. You know, was it a month? No, that's the yearly, that's the yearly interest that would have been accumulated on that loan. And so what Chris is showing is that we're holding back some funds in the loan repayment so that 338 can be paid at the end of the year. Now, alternatively, if you want to just continue the 6,000 for the year and just not pay the interest, that just rolls over into the principal of next year. So either one of those could be the approach.
Yeah, there's no right or wrong way to do it. That's the beauty. It's just however you want to build it. For that particular client, he just wanted it automated, right? He didn't want any surprise bills. He was kind of confused because he thought his 7.25% was covering the interest on the policy loan, but it wasn't. It was just paying the principal. But I said to him, and this is kind of the whole sum up, I said, you're actually making more money by paying just the principal, which is exactly what Craig showed. And I knew this was going to be the case, but you see, when I'm talking to the client, I hadn't run the math yet. So I literally took a guess, but just kind of understanding math, I'm like, well, since the insurance company charges it once a year and you're paying the principal down, of course, you're going to actually pay more down than you would with a home equity line of credit. Show the next one with the home equity line, because the home equity line, remember, every month, you'd be paying principal and interest, which means you're diluting your effectiveness of paying the principal down. Where with the policy, you're always paying just principal, which is reducing the APR more. Hence why when we saw that example with the, the one where you did them side by side, Craig?
Yeah, just one quick thing I was going to do before we
right.
leave this is, so in the model that you were sharing, where you've got that 338, let's just say we take that 338, divide it by 12, and just kind of reduce our monthly payment. So I'm going to say, what if we do 471.84? Okay, so that we have enough to pay at the end of the year. Well, what that did is it drove the interest up a little bit. So what I'm showing here is if you just said, you know what, I'm just going to pay the 500, because look at the balance going into year 2. It's 4,685. If I just continue to pay the 500 on principal, my balance going into year 2 is 4338. So even though we didn't pay the interest, we had more benefit.
Love that.
And
again, that's the beauty. You can do it any which way you want. There's no right or wrong way.
Yeah. So that's the thing. And if you want to pay the interest, great. If you want to just put it all in now and just reduce that. But so just want to kind of show that in the math.
This is just a sum up that shows, like, to that client and for all of you now, because we're teaching this to everybody, what started as just a simple text message from a client. I actually got 2 clients that asked the same thing, resulted in us saying, hey, if they're asking this, I bet you a lot of other people have this question, which indeed they did, because we had some people ask the exact question in the Q&A. This just mathematically showed to them, like, hey, what you're doing and what we're teaching you is actually economically better for you than what you would normally do with a home equity line of credit. Because the home equity line of credit, remember, it's the same interest rate that we calculated, but the home equity line of credit, you're paying more in interest, because every month the bank requires you to make interest payments. And if you're making interest and principal, they're taking the interest first, and then the rest is going to principal. With the insurance company, every dollar you're repaying to the policy in a policy loan repayment is affecting the principal. So you're effectively reducing down your APR more, and that was the mathematics that last slide showed. It just shows you that you paid less to the insurance company than you would a traditional bank in a HELOC. So, a lot of times back in the day, we used to say, well, this is the same as a HELOC, but it's actually not. It's even dollar for dollar, percentage to percentage, it's still better than a bank, because you are the bank and you are in control. And I don't know a single bank right now, and folks, correct me if I'm wrong, I don't know a single bank right now that you could go to where you could get a loan of any type, including a home equity line of credit, for less than 5.25%. Does anyone know a bank that will give you a loan for less than 5.25? Because I haven't seen one. As a matter of fact, just this morning on WTF, we had a report up that showed the loan rates on all different kinds of loans across the country. Not one of them was less than 5.25. So not only are you winning, the simple fact of the matter is you couldn't get a home equity line of credit that would ever match the loan interest rate of the insurance companies, because the insurance companies don't charge you prime plus. The insurance companies tie their loan interest to an aggregate bond index. So not to complicate you, but just know that's going to be lower than what prime is going to be. So always the insurance company is going to be less than what a traditional bank is lending, unless you were happen to get like one of those promo rates with the bank, but those usually only last 6 months or a year. So you're winning, and you're winning. I hope all of you are figuring that out. It's like you're winning because you're making money and still able to use it. You're winning because you're paying less to the insurance company. Even though they're charging you interest, you're paying less than you would ever pay to a traditional bank, dollar for dollar. And number three, you're in control. And you are not in control with any bank or any loan or any savings account.
It's beautiful, beautiful thing. And Chris, just to reinforce that point on the numbers, this is the HELOC calculator, which we're putting $500 a month into the loan repayment on a $10,000 balance. And to your point exactly, the first thing we have to do is pay the interest. So that means of the 500, we only have 458 reducing principal. And that's just the simple math of it. In the insurance company, we're not paying the interest first. We're putting it all towards principal. Those are the little tiny differences between the two. However, this is way better than a traditional mortgage with, where they're amortizing the payment, where probably 70% of the payment is interest versus, in this case, over 90% of it is principal. So anyway, this is just the math behind the scenes of how we got to this set of numbers.
Love it.
Now, one thing we didn't answer yet, Chris, is in the case of the client that we're working with, when he's overpaying. So if the insurance company's loan rate is 5.2 and he's paying throughout the year, we know that's going to be lower than 5.2. But if he's paying back at a 7.2 rate, isn't he going to pay the policy loan off?
Oh, yeah, he sure would.
And he still has money. What does he do with that?
Well, I mean, he has money, so it stays in the segregated bank account. Maybe he starts a second policy, maybe he sends the money out to work, or just lets it build up in the segregated account.
Yeah.
I personally would find a place for that money to go in the policy if I could. I would max out my PUA. I would pay off the loans faster. I would always utilize my banking system as its first stop. If I've exhausted that and I can't start a second policy, well, I'd probably just leave it in the bank. And every day I'd look at my bank statement going, damn it, I don't want that money there.
Yeah, that happens. For those of you that have read Becoming Your Own Banker by R. Nelson Nash, he's got an example in there. It's called the equipment financing. And the reason I'm showing these numbers is these are the numbers that come from the equipment financing. But if we were to take a $52,600 loan at 8.65%, we would structure a payment of $1,300. And so what Nelson Nash was talking about is, if I were to go finance a logging truck and it cost me $52,600 in my external financing, where a bank would finance that truck at 8.65%, then my monthly payment is going to be $1,300.23. So we all agree that that's just the math of it. If I go to a third-party financing system, if I go to a bank, that's what it's going to be, $1,300 a month. Now, this is where it gets into the client we're working with, where they're overpaying the loan. So what happens, and Chris shared some of the different strategies, but what happens if I'm paying 8.65% back on a insurance company loan that's at 5%? Well, the first thing we want to do is make sure we're an honest banker. So if we were going to pay the bank of somebody else $1,300 for 48 months, then we should pay our system back $1,300 for 48 months. But
Absolutely.
there's going to be excess, and that's the question. Where does that go?
But that's an important thing too, because some people would be like, well, why would I pay $1,300 if that's the same amount I would pay to the bank? And it's kind of a silly question. Once you go down this rabbit hole, folks, and you start thinking like your own bank, you would never ask that question. But for those just kind of looking at it from the outside in, they would be like, well, it's my money. Why would I pay the same as I would pay to a bank? Well, basically what you're saying in asking that question is that you're not as important as the bank is, because you're willing to pay yourself less than you would pay the bank. Why would you want to pay the bank more than you would be willing to pay yourself? Because the money you pay yourself is effectively your money that you get to use, that you get to keep, but you'd pay yourself less than you'd give to a bank. That just logically, when you become your own bank and think like the bank, that you would never ask that question. But I do think that it's important to cover that.
Yep. So now what we're going to talk about is there will be excess, and where does it go? And there's a whole nother discussion we can have around Nelson Nash's equipment financing. Chris, Steven, and I have done, the 3-day events where we've gone over that in great detail. But essentially think of it this way. This is a 4-year loan where we have year 3, year 4, And this is just a loan calculator. So if I'm being the honest banker and I'm putting $1,300 in for 4 years, we've already learned through today's session is that we're going to have a lower interest charge than the 5%. And we're actually going to pay this loan off. We're going to pay our life insurance company loan off in month 43. So that means for the next 1, 2, 3, 4, 5 months minus the 1280 that we still owed, we will have $5,220 extra that we need to pay to our banking system to be an honest banker. It won't fit. We can't pay any more to our loan in the insurance company because it's paid off. The insurance company is like, well, you have no loan left, but yet you're saying, well, I was told I should be an honest banker and continue this $1,300 a month. So now the question becomes, can you put it into the premium side of your policy? That would be the optimal thing to do. You may not be able to, you might be able to, but that's the first question we want to ask is, can I put some of that 5,220 into the premium side of my policy? If not, Chris said, what'd you say, just stick it in the segregated account?
I would just leave it in the segregated account until I had a place for that money to go, which
Yep.
when I looked at it, knowing the bank is using my money, I would find a place for that money to go as quickly as possible.
Yep. And it could be used for premium for the next premium. It could be, put into a deal, so it's still your money, but you want to allocate it to pay back that equipment that we purchased or the car that you purchased. So that's what's happening with that overpayment of money is it's either going to go into premium or it's going to sit in your segregated account. And like Chris said, it's going to go out to another purpose or it's going to be put into premium for the next year. But that's just how it's going to work. When you overpay your policy loan, it's going to get paid off and you're still going to have money to do something with. And so we just have to figure out where's the best place to put it. Now, if you consistently have that problem where you can't get enough money into your policy that you want to, that's a good time to have a conversation with us about, does it make sense to start more policies? Does it make sense to expand your system so you can put more premium in? So those are kind of some of the conversations we'd have at that point. So with all that said, I think that's all I've got.
Very cool. Stephen, you had a couple questions earmarked that you wanted to answer live?
Yeah, just so Sandy was asking, she has a new policy in March. She's borrowing $645 a month out after putting 1,000 in each month. For the first few years, she's only paying down debt, paying off debt. So what would her interest be for the year next March?
So there's a couple of things if she's gone through and done the debt blaster, for the folks that work with us, we do a debt blaster. And what we're going to do is focus on getting rid of those, high interest debts. So you might have a credit card at 29%. You might have a car loan at 8.5%, whatever it's going to be. We're not worried about paying the loans back on the policy until those debts are gone. But we could calculate that for you. It's just that interest charge is going to be minimal compared to what you're paying to Visa and Chase and the auto loans. So if you wanted to know your specific number, we could calculate that. If you've gone through the debt blaster process, we will have those numbers.
Very cool. And I've had a few people asking about the recording for this, so it'll be placed on YouTube at the Chris Naugle channel on Saturday. So I just placed a link over in the box for wealth webinar playlist.
Mhm.
So you can go subscribe to the channel, and that playlist right there will give you all of the latest wealth webinars. They're always posted on Saturday. All right. So Jay was saying, please explain when and how to use the IBC loan to pay debt, to pay credit cards, utilities, etc.
I'm going to let you take a look. I'm going to try to see if I have the loan calculator on a share where I can get it to others. So I'm going to look at that real quick.
Okay. And then Lois was saying the insurance company applies their loan interest to an aggregate what?
I didn't understand this question. I looked at this one, Craig. An aggregate what?
I mean, the loan interest is charged for any outstanding loan that you have.
Yeah.
Whatever the daily balance is throughout the year,
Right.
it's added up, and then you pay it at the end of the year. So
Yeah, so if you put 10K in a policy, and let's just say you took an $8,000 loan out right away. So the loan interest, let's call it 525. They would basically charge you, whoops, I should probably use red. Shauna said color code things. They would charge you 525 on the out $8,000. Now, if you did what we just explained, which was recapture, that money goes to work, and then you recapture the money, the recapture would reduce the interest owed, but nonetheless, the 525 would be charged on the 8,000 or whatever the outstanding loan balance is. So if you didn't pay the interest on it, let's just say like that one example, you did no recycle recapture, you just stole from your own bank and just used the money and never put it back in, the interest would roll back into the loan. So now your loan would be 8,000 plus 525, which I don't know what that it works out to be, but we'll just call it
420.
I was close. 8,420. So next year, now you're paying 525 on 8,420. See how it can work against you if you're not an honest banker. So option one, which was just don't pay the interest and let the interest keep accruing, is not a good option because it just costs you more money. So if you just take that money and you just roll it back into the policy, well, then you automatically are reducing the amount they're charging interest on. So it always works in your favor. Everything we're teaching, we're not teaching it so that you pay the insurance company more. We're teaching it so that you make and keep more of your own money.
And I put a link in the chat, which should allow you to download the loan calculator. So if there's anyone that can try that, and just let me know if you're able to access it and download it. For those that, it's a little different version than what we went over today, but it's the same math.
And also too, if any of you want to book a call, you just want to talk about your situation, like Lynn, said that must be what happened to me. Maybe booking a call and just say, okay, let's figure out what did happen to you. Let's figure out if you did it wrong or did it right and course correct. So whatever it is, if you want to book a call, you want to get a new policy started, you want to talk about your existing policies, you want to, just ask basic questions. Here's the link right there. All we ask is if you're brand new to this and you've never seen the main IBC video that we put out, please watch the video. You'll thank us later, I promise you. Watch the video and then book the call. And then if you've seen the video already, giddy up and go and click the link, grab a time, and we'll be happy to help you.
Hey, Chris, let me add to that also. So if you're new on Wealth Webinar, I understand this can be a lot. There might be certain details and things we're talking about here that you might be completely over your head. Just know that we do 6 live webinars every week to kind of bring all this together. So Wealth Webinar each week that you're on right now, this is going to be different each and every single week. It's sometimes going to have advanced investing strategies. Sometimes we're going to have asset protection. We might have advanced tax strategies. We might go back to the basics and talk about infinite banking from the very beginning. Last week we talked about cash flow and how to manage debt and how to start saving properly and that kind of stuff. So definitely go watch. If you missed last week, go check that out on YouTube on the playlist Wealth Webinar. You can watch all the past Wealth Webinars. Every Tuesday is a brand new 90-minute presentation. So what we call the main infinite banking training, the 90-minute, that's done every single Tuesday live. You can ask questions. It's done by different money mentors. So you hear different perspectives and different kind of ways to look at it because everybody's a little bit different the way they present it. So you can register for all these free webinars. I'll put the link over in the chat right now. You can register for all 6 free webinars every week with that link right there and just join us. Start coming around the campfire. You're never going to understand all of this stuff in one sitting. You're not even going to understand all this stuff in a few months. It takes most people several years to really start fully grasping, understanding, and implementing everything we teach. I've been doing this now for well over 15 years. Chris, you've been doing it for well over 20 years. Craig, I know you've been, came from another career where you practiced a lot of this and then got on this teaching side just in the past 5-6 years. So we have a lot of experience. So don't, feel like, hey, this is beyond me or too much or anything like that. Trust me, we all started at the beginning. We all started with, holy shit, this is a mindset change. This is a different way of looking at money, a different way of looking at things. And then from there, it's just a matter of grinding it into you and really fully grasping and taking it one step at a time. I saw in the chat box, I love this comment right here from Lucy. Lucy said, before IBC, sorry, the chat is moving so fast. Before IBC, my savings always bled out. I could never build it up. After IBC, my savings stays my own and keeps growing all the while I can use it. Thank you, Chris, Stephen, Craig, Sean, and the whole team. We have people like Dexter. I don't know if Dexter's on right now, but he's seen this presentation from Brent Kessler, from Hannah, from Chris, from probably 10, 12, 20 times he's seen the presentation. He watched me on one of the webinars one time explain one section of it for 5 minutes, and that's what clicked for him. So everybody's a little bit different, so just stick with us and hop on the phone, and it will make sense. I promise you that.
Yeah. It's just new. I mean, it's like anything else though, right, Stephen? I mean, if someone wanted to learn how to play guitar, you're not going to just grab a guitar and start playing. You're going to have to learn. You learn like one simple song, then you expand on that. Same thing like piano. I'm watching my daughter, learn how to play piano, and they learn like a couple keys and a couple more, then a song, really simple song, then another. And driving a car, like all of you drive a car and you remember what that was like. You were scared to death when you first got in that car. But eventually you started learning. You learned all the things. And then, oh gosh, who remembers that parallel parking with that driving instructor, right? To get your license? Terrifying. You do it once, you hit the curb, you're like, oh, I'm going to fail. And then you do it again, you get it, and you're like, I think I failed. But then you pass and you're excited. Now you don't even need to think about it. Hell, now the car just parks itself for you. Well, we're getting to that point where IBC will just IBC itself for you, but we're not quite there like the self-parking cars. But I promise you, in the future, we will be there and we will have IBCs for you in a roundabout kind of way. But nonetheless, just remember, it's learning a new skill, and a skill that will continually help you earn more, control more, and it will add to your family's financial wealth, your generational wealth. That's guaranteed. And hey, listen, for some people, it's nothing more than a glorified savings account. That means that they'll have more money tomorrow than they had today. So again, everybody's different. Some people are just the simplest form. Hey, I just want to put money into a whole life policy just to leave it there, to let it grow because I don't want to play the game with the banks. Fine. A whole life policy is going to be better. And we've shown that mathematically over and over again. And if you actually here, I want to put a video up because a lot of people have been asking about this. I don't know why. It's sort of just seems to be happening, but me and Craig did a video, and I'm going to put it in the chat. So what this does is, let's just say somebody had a lump sum of money and they just wanted to put the money in one time. They didn't want to deal with premium deposits. They have a lump sum, one-time deposit. In this video, what we did is we gave 2 examples of how you could handle that. And both of them, just so you know, in the long run worked out to be like just under 3% interest every year for the rest of your life. Like that was your average. It was more in the later years, less in the early years, but averaged out to be almost 3%. So I know when you hear that number, you're like, that's not very much. But the other thing that person had is that they were making, I don't remember what it was, Craig, 2.78%. Let's just call it that. They were making that 2.78%. And it was tax-free in the one example. So 2.78% tax-free is more like making almost 4%. But even 2.78%, it's more than what you're going to get in a savings account. It's more than you're going to get in a high-yield savings account, because the average over 10 years in any savings account in this country, Craig, what was that number? I think people forgot.
0.42, 0.6, somewhere in that ballpark.
It was 0.42%.
Yep.
Less than 0.5%. Where in the policy, you can earn just under 3% average every year, guaranteed, plus get a death benefit and have access to your money. So you see what I'm saying? Like, even for the simplest use of just, hey, I'm just looking for somewhere to put money and I just want to stash it somewhere. This is probably one of the best places you're going to put. I would rival and say that this is probably even better than putting it in treasury bonds. So for whatever your need is, folks, we're here to help. And we will always be here to help. So please reach out to us, book a call. With that being said, thanks, Stephen. Thank you, Craig, for all your hard work and putting this together. And thank you to all of you. We had over 200 people on. It's pretty awesome to see that. At one point, I was sweating bullets trying to answer the chats. Stephen came in with his magic fingers and knocked them out of the park. So with that, thank you guys. And we will see you at 4:30 for Ask Me Anything happy hour. Till then, have a good day. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button, actually smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.